once the correlation is established between the market and a particular news event, it tends to stay that way for some time. Now, you can determine when the correlation is broken by the fact that, let's say a few days from now, oil goes up another dollar, but the market doesn't react to that. Or it goes up $5, and all of a sudden the market starts, instead of going down, it's doing the exact opposite. It goes up or something like that. Then you realize at some point in the future, that correlation will be broken. And another correlation, another news item. That's why you have to kind of, perk your ears up and kind of listen for the news and see, okay, the market went down or the market went up based on such and such. All of a sudden, there's a new correlation in the market, and it's just not negative news items that sends the market down. It's also positive news items that sends the market up. For example, if there's a trend of higher productivity, higher GDP, less jobs claims, unemployment claims, or less there's a greater number of new jobs being created, or something like that along those lines. Then all of a sudden there's a correlation with economic news, positive economic news, and those tend to send the stock market higher. So if you know that there's potential for the market to move higher based on your technical analysis that we've done, and there's a jobs report or there's a GDP number coming out, you can sometimes get ahead of that news and plan your trades a little bit further in advance. So that's a very interesting correlation. There's a correlation with the news. Now, after what's interesting is after this decline in the market and the credit crunch, I think the bottom was down. Let's see, where was it? Maybe it was down in here. That the Bear Stearns debacle happened, so the market really sold off on that. But then it recovered and went back up again. So that seemed to be like maybe it was back in here someplace, but that seems to be like the that was kind of like the climax of the correlation right there. That was like the high point of the whole credit crunch was the Bear Stearns takeover by J.P. Morgan, and the stocks, the shares of the stock, were like decimated. They were just like down to almost nothing. It was like $2 a share, and it was really bad. So, those kind of news events are catastrophic, and if you know that is probably the end of all the bad news that's coming out. There might be more bad news coming out, but generally that was the biggest of all the bad news items that came out. And at that point, if you took a look at this chart, if you took a look at the VIX, you may have seen some sort of momentum building for a rally to the upside, especially now that news is out. So keep, if you're interested in, plugging that into the formula, using your technical analysis, using your support and resistance points, and then keeping an eye on the news just to see what the market actually is reacting to, or at least perceived to be reacting to. It does help in helping you time your entrances into the market, especially when we get into Module 11, when we actually go into individual stock picks. So that's something to keep an eye on. It's very, very interesting, and it happens throughout. It's happened for years and years, at least 20 years since I've been following the market. There's always some justification or some reason why the market is going down, and a correlation is established, a relationship is established. Here, during this down period, it was the credit crunch. Now, to this down period, it's oil. Who knows what it's going to be in another couple months, but they'll always fixate on something. Okay, let's delve a little bit deeper into technical analysis as far as indicators go. I'm not a big fan of moving averages. I'll be honest with you. Price has its place. If you use the majority of indicators, in other words, that are being used by a lot of traders, have to do with the manipulation of price. You have moving averages. I do have one moving average, and this is the only moving average that I use, and that's the 200-day moving average. I don't find it particularly helpful, except to kind of determine the very, very long-term trends. On a weekly chart, the 200 period moving average is way below the current market. On a daily chart, we're below the 200-day moving average. So, I think it has some. It kind of gives you a general idea of the trend, but you can see that, the trend was going up here, and even though the market was falling, the moving average was still rising. It didn't top out until the market had bottomed, and then it started going down. So it's a real lagging indicator. I think price in general is not the best indicator, or not only that, but it's not the best method of determining the highest probability future movements of the market. And the reason for that is that price is really just it's kind of a picture of the current state of the market, but it has no value to help you determine what the probability of future prices are going to be. The reason for that, I think, is prices just don't, they move up and down based on what people are buying and selling and feeling comfortable with the level at which they're buying and selling. But what we really need to do is take a look at both volume and one other indicator that is not smooth. The problem I have with smooth indicators like this MACD down here, I do have the MACD up, but to tell you the truth, I don't even look at it. The MACD is simply a moving average convergence divergence. That's MACD, moving average convergence divergence. They use two different, or actually there's a center line and then there's two moving averages, and they take the difference of the two moving averages to determine some sort of trend line. And to tell you the truth, I don't even look at it. I've got it down here, but it doesn't really, I really don't look at it that much. All these indicators, stochastics, MACD, just about any of the studies that you can bring up, in here there are a huge, there's lots of stuff you can do. You can do the 200-day moving average, 50-day moving average. They have something called Bollinger Bands, which, at times may be helpful because Bollinger Bands basically just kind of give you what the standard deviation moves of a market is. So this is, they would put on the lower line is maybe one standard deviation to the downside. The higher bands is one standard deviation to the upside. Maybe it's two standard deviations. I don't know how I've got this set up here, but generally what will happen is, you can make a determination, well, okay, it's very, very close to the standard to the upside, and then these things can be helpful. I put up different patterns and studies, but to be honest with you, I don't really rely on them at all because they're lagging indicators. They really don't. They don't help me determine what the potential or the probabilities of future prices are going to be. Let me clear these out. So I don't generally use them. I use two other indicators that are not really indicators, but actually what they are, they're measuring the internal strength of the market. And I have found these to be much more useful than any other tool I have ever used. These two tools include the majority of the breadth, which is the number of advancing and declining issues in the New York Stock Exchange, as well as the difference in the up volume and down volume of the New York Stock Exchange. And I'll bring these two charts up for you in just a second.